Gold prices in India continue to surge to new highs after having crossed the key psychological level of 50,000 rupees per 10 grams. Let's do a three-point analysis to find out what is the outlook on the yellow metal. 1. Will the gold rally sustain? Well, international gold prices have been on a rise for the last few months. Now, if you see tracking these gains in the international markets, the Indian gold prices or the spot gold prices have climbed over 50,200 rupees today. Now, gold prices are already up about 30% this year. And a host of factors like global uncertainties triggered by COVID-19 pandemic, the weak dollar, geopolitical tensions, and the stimulus programs have all increased the appetite for gold. Now, gold has always been considered as a safe haven. And whenever the stock markets, the real estate and the bonds fall all across the markets or the world, investors turn to gold to park their funds. Now, veteran investor Mark Mobius, who has been quite bullish on gold for quite some time now, says that the yellow metal still remains attractive despite the big rally that we've already seen this year. Now, analysts believe that the ultra-low interest rate environment will also support the strong flight to quality flows into gold going on from here. Others say that gold has corrected enough for the last 6 years and is at the right stage of a bull run. 2. Should you invest in gold at 50,000 level? Well, investors who have missed out on the rally in gold prices are definitely looking at investment opportunities in this asset class. Now, Navneet Damani of Motilal Oswal Financial Services has told Moneycontrol that given the current macro backdrop of whether we expect the momentum to continue or not, he says that it could actually deliver handsome 30% returns, and they are targeting at 65,000 rupees per 10 grams over the next 18 to 24 months. At the same time, some of the experts and analysts believe that while it is important to have gold in your portfolio to achieve portfolio diversification and also as a hedge against inflation, but going overboard also is not the right thing to do, because gold has a tendency to remain range bound for a long time. Now, most of the experts have also recommended investors to increase the allocation of gold from 5 to 10% in the overall portfolio and not invest in gold by merely looking at the short-term returns only. 3. Which is the best way to then invest in gold? Well, remember that buying gold for investment purpose is different from buying gold jewelry for your own consumption. Now, making charges and taxes which are irrecoverable in nature consist of up to 25% of the value of gold jewelry, making it an unattractive investment proposition for the long term. Experts say that it is a better idea to invest in gold, which is in the form of gold ETFs and sovereign gold bonds. Now, sovereign gold bonds are issued by the government at regular intervals. It has a fixed tenure of 8 years, but it can be sold after a lock-in period of 5 years. But holding it until maturity attracts no capital gains tax on the investment. Now, gold ETFs are simply funds that invest in gold, and they can be bought and sold on the stock exchanges just like any common stock. Now, in such funds, capital gains earned after 3 years of investment are taxed at 20% after indexation.